Welcome back to the deep dive. It is Tuesday, February 3rd, 2026.
Hey there.
And I have to say, if you've been watching the semiconductor tickers lately, it really feels like the ground is shifting under our feet.
It really is. I mean, we are looking at a completely different landscape than even, 5 years ago. The pace is just relentless.
Exactly. And today we're focusing on a company that I think a lot of us still have a specific, almost nostalgic connection to, the Comeback Kid.
Right.
The company that went from being the bargain bin option for your gaming PC to basically holding up the pillars of global AI.
Yep. Advanced Micro Devices. AMD. It is a fascinating case study in pivoting, maybe the best one in tech history.
And our mission for this deep dive is pretty specific. We aren't just looking at the stock chart and guessing. We need to figure out if this data center first strategy is actually paying off.
In real dollars, yeah.
And we need to shine a light on some scary risks that I don't think enough people are talking about. And finally, answer that big question for our value investors. Does the price tag actually make any sense?
Right. Because as we always say, a great company and a great stock are two very, very different things. You can love the product and still lose your shirt.
So let's orient ourselves. We're in early 2026. What are the headline numbers telling us right now?
Well, to really get the momentum, you have to look at how they closed out 2025. The guidance for Q4 25 set the revenue midpoint at roughly $9.6 billion.
Okay, let's just pause on that. $9.6 billion. For context, that's nearly $1 billion of silicon moving out the door every 9 days.
It is massive, and that represents a 25% increase year over year.
Wow.
And that came right on the heels of a record-breaking Q3, where they hit $9.2 billion. That was up 36% from the previous year.
Those aren't just good numbers. 36% growth at that scale. That feels like an inflection point.
It is.
It feels like they're not just participating anymore. They're actually driving the market. But I have to play skeptic here. Is this just a temporary bump, or is this sustainable?
That's the right question. And the key is not the raw number. It's where that money is coming from. If this was just selling more PlayStation chips, I wouldn't be impressed.
Right, because I remember when AMD was synonymous with, consumer electronics. You bought AMD because you couldn't afford Intel. Is that still the business?
Not anymore. That's the profound shift. The data center segment is now the absolute crown jewel. In fiscal year 2024, that segment alone brought in $12.7 billion.
12.7?
Which was nearly 48% of their total revenue.
So practically half their money comes from the cloud now.
Essentially, yes.
Yeah.
In Q3 of 2025 alone, data center brought in $4.3 billion. They've effectively transformed into an enterprise infrastructure company.
And what's the actual hardware driving this? Is it just regular server stuff, or is this all the AI hype?
It's a mix, but there are two main engines. First, you have the 5th-gen AMD EPYC processors, the Turin chips. The hyperscalers love these for general compute.
Okay.
But the real sexy story is on the AI side, the aggressive deployment of the Instinct MI350 series GPUs.
Okay, we hear this term hyperscalers thrown around constantly. Hyperscalers are buying chips. Who are we actually talking about here?
We are talking about the cloud giants.
Right.
Amazon Web Services, Microsoft Azure, Google Cloud, Oracle. These 4 or 5 companies account for a massive portion of that revenue.
Which sounds great, but doesn't that make you a little nervous? I mean, that's a huge concentration risk, right? If Microsoft sneezes, AMD gets a cold.
It's a risk, absolutely.
Yeah.
But right now, they're in an arms race. They have to spend. They can't afford not to.
Speaking of that arms race, I saw something in the report about a specific partnership that really stood out, the aha moment.
You're likely referring to OpenAI.
Yes. That seems like a huge deal.
It's a landmark operational highlight. AMD was designated a preferred partner to deploy 6 gigawatts of GPU capacity.
6 gigawatts. I looked this up. That's roughly the power consumption of a small country.
It's insane, and it validates the technology. When the biggest name in AI modeling, the people who built ChatGPT, choose your stuff,
It sends a signal to everyone else.
it tells the CFOs at other companies, it's safe to buy AMD. You're not taking a risk anymore.
And I have to assume selling these high-end AI chips is a lot better for the bottom line than a processor for a $500 laptop.
Oh, significantly. Selling consumer chips is a volume game, razor-thin margins. Selling top-tier AI accelerators to a hyperscaler, that commands a premium.
Which leads to better margins.
Exactly. AMD's GAAP gross margins hit 52% and non-GAAP hit 54%.
54%. That's software-level profitability on hardware.
It's very, very healthy. It means for every dollar they take in, they keep 54 cents before operating costs. Gives them a lot of ammo to reinvest.
And they need it. Because, okay, here's where we have to address the elephant in the room.
The 800-pound gorilla.
The company in the green leather jacket, NVIDIA, they've practically owned this market. The report says they have something like, 90+% market share?
The report is clear on this. NVIDIA still dominates with a 92 to 94% share. AMD holds roughly 6 to 7%.
Oof, single digits. That doesn't sound like a rivalry. That sounds like a monopoly. Why are we even excited about 7%?
It looks small on paper, but, and this is crucial, AMD has positioned themselves as the primary second source.
Okay.
And in a market this big, getting 7% is incredibly lucrative. Plus, the customers, Amazon, Google, Microsoft, they hate being dependent on one supplier.
Right. It gives NVIDIA too much pricing power.
So they need AMD to succeed just to keep NVIDIA honest.
So AMD is the strategic alternative. But do they have the tech to back it up, or are they just the cheap option?
No, the tech is very real. They've built a moat of their own using really 3 structural advantages. First is architecture. Their Zen CPU architecture gave them the lead in performance per watt.
Which matters when you're paying the electricity bill for a 6-gigawatt data center.
Precisely. Power is the biggest constraint. The second is chiplets.
I've heard this term, chiplets. It sounds like a snack food. Explain that properly. Why does this matter to an investor?
Think of it like Legos. Traditionally, you make one giant, expensive chip, a monolithic chip. The problem is, as they get bigger, they're harder to make perfectly. If one tiny part is broken, you have to throw the whole thing away.
Right, that sounds incredibly expensive. You ruin the corner, the whole slab is trash.
Exactly. AMD pioneered a different way. They build smaller, modular pieces, the chiplets, and connect them. If one is bad, you toss it and grab another.
You don't scrap the whole processor.
You don't. It lowers costs and increases yield, how much usable product you get from a silicon wafer.
Smart. It's like building a house with prefab rooms instead of casting the whole thing in concrete at once.
That's a great analogy. And it lets them scale performance faster.
So they have the hardware efficiency, but I always hear that NVIDIA's real weapon isn't the chip, it's the software. See you day.
Correct. And this is the third pillar and the main battleground for 2026. NVIDIA has a walled garden. Developers have spent 15 years learning CU Day.
And once you're in, it's very hard to leave. It's sticky.
Very sticky. So how does AMD break that? Well, they are betting on open source with their ROCm platform.
Can they do it, though?
It's a huge hill to climb, but the industry is helping them. Tools like PyTorch are now abstracting away the hardware layer.
Abstracting away. Break that down for us.
Well, think about it like this. You don't write web code for a specific brand of monitor anymore, right?
No.
You write code that works on any screen. In the same way, AI code written in PyTorch is starting to care less if it's running on an NVIDIA chip or an AMD chip.
Ah, I see. The software translates it for you. So it's the Android versus iOS dynamic. NVIDIA is Apple closed, premium, vertical.
And AMD is Android open, everywhere, flexible. And if history tells us anything, open systems usually win in volume over the long run.
So they have the tech, they have the partners, the strategy. It sounds perfect. Let's take off the rose-colored glasses. What keeps Lisa Su up at night?
There are significant headwinds. The biggest one is geopolitical. It's a tail risk.
Let me guess. Taiwan.
Yes. AMD is fabless.
Meaning they don't actually build the chips themselves.
Right. They design them, but the manufacturing happens at TSMC in Taiwan. They rely almost entirely on TSMC for their cutting-edge chips.
So if anything happens in the Taiwan Strait, blockades, conflict.
It's a catastrophic supply chain disruption. Revenue goes to zero overnight. There is no viable alternative on the planet for that kind of manufacturing.
That is terrifying. And we're already seeing trade wars impact them, aren't we?
We are. The U.S. export restrictions meant that their Instinct MI308 shipments to China were totally excluded. Zero revenue from a huge market.
What about the economy, the AI bubble fear?
That is the other major one, the CAPEX cliff.
The cliff, explain that.
Right now, Google and Microsoft are spending billions on infrastructure. That's CapEx. But they need to make money back on it.
Right.
If ChatGPT doesn't generate massive profits soon, shareholders will say, stop buying chips.
And if the buying stops, AMD hits a wall.
Exactly. And there's a data point in the report that hints at this pressure. Their inventory to COTO-GS ratio rose to 1.74 in Q3 2025.
So inventory is piling up.
It's getting higher. Could be they're stocking up for a big order, which is good, or it could mean chips are sitting on the shelf. It's a metric to watch.
Okay, high stakes. Let's talk about the person steering the ship. Dr. Lisa Su.
The architect. She's been CEO since 2014. I mean, she took this stock from under $2 to over $200. That's legendary status.
And she's an engineer, right? Not just a suit.
PhD in electrical engineering from MIT.
Yeah.
She gets the silicon. Her philosophy is best products. Technical excellence over marketing fluff.
And for shareholders, her incentives are aligned.
Oh, yeah. She holds over $1 billion in shares. Massive skin in the game. Plus, they're returning capital. A new $6 billion share repurchase program.
Buying back their own stock. Ultimate vote of confidence.
It is. Total authority is around $10 billion for buybacks.
All right, so great company, legendary CEO, massive growth. Now we have to put on our value investor hats. Is this a great stock to buy right now?
And this is where it gets tough. This is where the rubber meets the road.
Okay, hit me with the Buffett checklist.
Well, let's start with the pass. The balance sheet is pristine. Debt to equity is 0.06. Practically no debt. They're printing cash.
So they're not going bankrupt.
Far from it. But the valuation.
How bad is it?
It's steep. The stock is trading around 246 XRs. That gives them a PE ratio price to earnings of a staggering 114.9.
114. Wait, Buffett usually looks for what, under 15?
Ideally, yeah. A PE of 115 implies it would take 115 years to earn back your investment at current levels. The market is pricing in massive future growth.
And price to book?
6.7. Value investors want under 1.5.
So there is absolutely no margin of safety here.
None. The intrinsic value is estimated around $182. Trading at 246 XRs, it is priced for perfection. This is a growth at any price stock, not a deep value one.
It feels like the market has already priced in all that success. If they miss earnings by a penny, the stock could tumble.
Precisely. But, the market is heating up, and sometimes momentum overrides value.
It's such a tricky environment. It's hard to know where things stand. Speaking of market temperature, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
It's a really useful tool in this kind of volatility. It helps you see if the overall market is getting overheated, not just one stock.
Absolutely. And before we give our final verdict, I do need to add, disclaimer, full deep value research reports can be found in the description links. All of this is based on public sources and is for educational purposes only. It's not investment advice.
Always do your own homework.
Conduct your own due diligence. If you want to listen to our full deep dive or access more, you can join the Deep Value Club membership or subscribe at deepvalues.ai. And don't forget to like this video.
Much appreciated.
So let's wrap this up. What is the verdict on AMD in 2026?
The summary is this. AMD has successfully transformed. They're a data center powerhouse with a real defensible moat in chiplets and open software. They're the only real alternative, but the valuation leaves zero room for error. If there's a geopolitical flare-up or the AI market corrects even slightly, that stock price has a long way to fall. It's a high-wire act.
So maybe a hold.
No.
Or a buy on a serious dip.
Definitely a company to watch, but buying at the top requires a very strong stomach.
Before we go, leave us with one final thought to mull over.
Okay. We talked about the software moat. Everyone thought NVIDIA's QD was invincible, the standard.
Right.
But look what happened with mobile phones. We are witnessing the Android versus iOS moment of the AI era. If AMD becomes the standard for the open ecosystem, the Android of AI, that 7% market share could look very different in a few years.
They might not kill the king, but they could rule half the kingdom.
Exactly.
That is a huge thought. The Android of AI. We'll see if Lisa Su can pull it off. Thank you all for listening to this deep dive.
Thanks for having me.
We will see you on the next one. Stay curious.